Hi. In this video, we are going to discuss one of the major Indian economy updates. That's with reference to the monetary policy and the introduction of the SDF. You might have heard about the introduction of SDF. Okay, this is one of the recent Indian economy update, especially one of the latest monetary policy committee decided to introduce SDF. And let us see and let us directly jump into the topic. Okay, so before going to the SDF and its definition and its introduction method, we should understand what's LAF, that's the Liquidity Adjustment Facility, and what's LAF corridor, that's the monetary policy corridor, and what's its width, and what do you mean by repo, what do you mean by reverse repo, and then what do you mean by MSF, and the latest item, that's the SDF. Okay, let us check one by one. First of all, SDF. What do you mean by SDF? Concept is technically same. That's the reverse repo. I mean, technically the meaning of reverse repo and SDF are one and the same. So, what do you mean by reverse repo? If you are a commercial bank, whenever you are having excess liquidity, you can park this excess liquidity with the Reserve Bank of India and then you can receive a rate of interest against your deposit. That's the reverse repo. But reverse repo, there is repo, repurchasement agreement, reverse repurchasement agreement, which means you have to give collateral in the form of government security. Okay, that's one of the mandatory items you have to follow if you are depositing currency with the Reserve Bank of India under the heading reverse repo. But already I told you, this is the same item, the same meaning of the reverse repo. The purpose is also the same, but there is one difference. If you are parking your excess liquidity with the Reserve Bank of India under the heading SDF, you need not give collateral as backup. I mean, you need not to submit government securities there as the collateral. So that's the one and only difference between the SDF and then the reverse repo. So by definition, this is an additional window, additional liquidity window available before every commercial bank where you can park your excess liquidity with the Reserve Bank of India and in return you can receive a rate of interest that's called SDF, and most importantly without the collateral, I mean government security. And this was recently introduced on 8th of April 2022. Okay, and then let us explore more about the concept. See, the SDF introduction is one of the milestones as far as the monetary policy statements are being concerned. The recent monetary policy committee came up with the declaration that they are going to implement, they are going to replace reverse repo, and instantly they are going to introduce a new monetary policy quantitative instrument which is nothing other than SDF. So that's the point. This is the so-called SDF, Standing Deposit Facility, is one of the monetary policy instruments, especially quantitative instruments, and this can absorb money supply from the economy. You mean absorb a large amount? That's the potential of the SDF. Why such a statement? The SDF, it's possible to absorb a large amount from the economy. Can you connect the point? Yes, because here you need not to submit the government security as collateral. So there is no binding constraint over the Reserve Bank of India as well as the commercial bank. So the capacity to absorb is very high. So the recent changes are like this. Reverse repo has been replaced by SDF. And now the new floor rate, that's it, not the point. Now the new floor rate is SDF. Then it was reverse repo and now it is SDF. Okay, so this is one of the major latest changes as far as the Indian economy is being concerned from the perspective of the monetary policy. You see, this is the chronological order of the events as far as the introduction of the SDF is being concerned. So this was recommended by the Urjit Patel committee. You know, the former Reserve Bank of India Governor Urjit Patel was the chairperson of this committee, and he suggested the introduction of SDF as a floor rate in 2014. And as all of you know, RBI, Reserve Bank of India, it's a statutory body. Okay, Reserve Bank of India Act of 1934. You have to amend this to introduce something new. So in 2018, Section 17 of the Reserve Bank of India Act of 1964 was amended for the introduction of the SDF. That's the information you should not hear. And I want you to remember the point even. Okay, and then you know the result then. The recent Monetary Policy Committee announced the replacement of reverse repo and introduced new SDF on 8th April 2022. So this is the chronological order of the introduction of SDF. Started from 2014, that's the recommendation of the Urjit Patel committee, and then followed by amendment of the Reserve Bank of India Act of 1934 in 2018, and eventually introduced on 8th April 2022. That's the chronological order of these incidents as far as the implementation is being concerned. Okay, now we are going to check the major features of the new monetary policy instrument. That's the SDF. Already I told you, this is one of the quantitative monetary policy instrument which replaced reverse repo as the floor rate of the LAF, that's the Liquidity Adjustment Facility. See, the first feature is the floor rate of Liquidity Adjustment Facility was now SDF. Reverse repo was replaced by SDF as the new floor rate. Okay, that's the first feature of the newly introduced SDF. Now, reverse repo is not the floor rate of the LAF corridor. Now it is SDF. And you know that under the reverse repo, if you are parking the excess liquidity with the Reserve Bank of India, commercial banks have to submit collateral, I mean government securities. But here it is, there is no such a requirement. You need not to give any collateral backup to park the excess liquidity under the heading SDF, which means a large amount it's possible to absorb if you are using the latest monetary policy absorption instrument, that's SDF. This is non-collateral instrument, not the point. And then this is also one of the overnight basis loans actually. You know that repo, reverse repo, all these are overnight loans, not for the long period of time. This is just for 1 day or 2 days or for maximum of 1 week or something like that actually. That's the third feature. And another feature, you know that reserve ratios, cash reserve ratio as well as the statutory reserve ratio, liquidity ratio, SLR as well as ZRR. Okay, every commercial bank has to keep a certain proportion of net demand and time liability with the Reserve Bank of India. That's the CRR, and right now it is 4%. You know that actually. Okay, and then at the same time, every commercial bank has to keep a certain proportion of their net demand and time liability as liquid in their own vault. That's the SLR. Okay, so what is the connection of this CRR and SLR with reference to the SDF? The point is, every commercial bank has to keep certain proportion of their net demand and time liability as CRR, but the deposit which comes under SDF will not be considered for the CRR maintenance. Okay, you need not to consider this amount, okay, for the CRR. But at the same time, SLR, if you are maintaining the SLR, that's mandatory for a commercial bank. So they have to consider this SDF balance under the SLR. So that's the another feature of the newly introduced absorption monetary policy instrument SDF. The balance will not be considered for the CRR, but the balance will be considered for the SLR. Not the point. Okay, for your exam point of view, that's key information. Not it. And see, removal of binding constraint. That's one of the major feature. Again, you can point. what's the meaning of the removal of binding constraints? Reverse repo and SDF, both are one and the same. You can park your excess liquidity with the Reserve Bank of India. But what's the difference? Collateral was there with reference to the reverse repo, but collateral is not here with the SDF. That's the difference in fact. So, backing up of collateral and then the maintenance of the collateral was one of the binding constraints as far as the Reserve Bank of India as well as the commercial banks were being concerned. So, now it is being removed. The reverse repo was replaced by the SDF as floor rate. Now you need not submit collateral, government security. So now what's it? The constraint has been removed there, which means with the introduction of newly introduced SDF, a binding constraint was there, then with the reverse repo, and now it is removed because there is no need of backup with the collateral in the form of government security. That's another feature of SDF. Okay, so this is the latest monetary policy corridor. The middle, that will be repo. Upper ceiling, that's MSF. Floor rate or the lower ceiling, that's the SDF. And in the middle, you can see that's the call money rate. And most importantly, the monetary policy corridor width, that's the 50 basis points right now. Okay, so we will check one by one what's the meaning of all these. What do you mean by SDF, and what's the meaning of reverse repo, what's the meaning of repo, and what do you mean by call money rate, and eventually MSF. All we will check one by one. Okay, so here we go. What's monetary policy corridor? So, monetary policy corridor refers to the area between MSF and the floor rate, that's the SDF. That's the meaning. As far as monetary policy is being concerned, there are basically four objectives. You know that. Price stability, exchange rate stability, financial stability, and economic growth. For the growth, there should be money supply. But for price stability, money supply shouldn't be much. Okay, that may be converted itself as the so-called inflation sometimes. So, an inflation which is above 4% is always inimical to economic growth. So, what's the meaning? For the economic growth, there should be adequate money supply. But at the same time, there should be enough money supply for economic growth in order to support the basic economic activities. At the same time, there shouldn't be inflation. This is the task of the Reserve Bank of India. Just maintain a fine line. No inflation. Neither inflation nor deflation. At the same time, enough liquidity for the basic economic activity in order to support the economic growth. So, challenging task. It is really challenging. So, the monetary policy corridor means through the LAF, the money supply of the Indian economy is being exactly controlled, contained or regulated through a systematic window. For that, there should be a width. This width is called what? The so-called monetary policy corridor. The upper ceiling of the monetary policy corridor is MSF, Marginal Standing Facility, which was introduced in 2011-2012 through the recommendation of the Deepak Mondi Group. And this was an additional borrowing window available for every commercial bank above the repo if you want to borrow something. And then, what is the SDF? That's the floor rate now. That's a floor rate now. Already you know the meaning of the SDF. Okay, so this replaced the reverse repo. And then the middle, that should be the repo. And within the corridor, there will be call money rate. So this is the monetary policy corridor right now. See, upper ceiling, that's MSF. Middle, that's repo. Lower ceiling, that's SDF. And then around the repo, that's the call money rate. Okay, so let me define one by one. What's MSF? This is the rate at which the Reserve Bank of India lend loan to the commercial bank. And as backup, there should be collateral. That's the government security within the SLR requirements. That's the difference between the so-called repo and MSF. Technically, repo and MSF both are same. The only difference is if you are borrowing under repo rate, you have to pledge the government security above the SLR requirements. But if you are borrowing, if you are a commercial bank under the MSF, So you can pledge the government security even within the SLR requirement. So technically the meaning of MSF and repo rate is one and the same. The rate at which Reserve Bank of India lends money to the commercial bank. And SDF, you know the meaning. Liquidity window, where you can park your excess liquidity with the Reserve Bank of India without the collateral. That's the SDF. And the call money rate. What's it? Call money rate. Okay, you know that scheduled commercial banks, each of these, it's possible to lend and receive loans. Okay, if some bank is lending, those who are having excess liquidity to the another bank, those who are facing shortages, and then there will be a charge in the form of rate of interest. That's called call money rate. Call money rate is the rate of interest charged by a commercial bank who lends loan to the another bank actually. Only scheduled commercial banks can participate the call money market. You know that actually. So this is the minimum basic meaning about the these 3 to 4 items: SDF, repo, call money, and then the MSF. And now we have major heading here. What's it? LAF, Liquidity Adjustment Facility. What do you mean by LAF or the Liquidity Adjustment Facility? It's so simple. You know that. Already I told you, for the economic growth, there should be money supply. But if the money supply reaches a certain limit, that may convert itself as the inflation. And inflation which is above 4% or the upper tolerance level which is 6, upper tolerance level 6, which above the upper tolerance level may enter the economic activities. That's not desirable as far as the Indian economy is being concerned. So there should be money supply. That money supply, that should be optimum. Okay, at the same time, there shouldn't be inflation. So what do you mean by such a statement? The task of the Reserve Bank of India. First objective, that's the price stability. Last objective, that's the economic growth. So you have to maintain a fine line, which means you need money supply for the basic economic activity. At the same time, that money supply shouldn't be one of the reasons behind the inflation actually. You know the third reason of inflation. What's it? Inflation might be caused by demand side, sometimes supply constraints, and even the cost of production, and eventually there is money supply. And enlarged money supply, high money supply is always associated with the high price level. That's the inflation. So we need money supply for the basic economic activity. At the same time, that money supply, that should be optimum. So you have to regulate the money supply in a systematic window. That systematic window is called what? LAF. So simple. The money supply of the Indian economy is being controlled by the Reserve Bank of India systematically by using many of the monetary policy instruments like repo, MSF, and SDF. And then it was reverse repo, the floor rate. Now it is the SDF. And this process is known as what? The LAF. That's the Liquidity Adjustment Facility. Okay, so simple it is. The systematic window through which RBI regulate, contain the money supply. That's called what? The Liquidity Adjustment Facility. See, LAF was suggested by or recommended by Narasimham Committee 2 in 1998. Okay, then the Reserve Bank of India introduced an interim LAF in 1999 and eventually on 5th June 2000 we introduced full-fledged LAF, and this is the chronological order about the Liquidity Adjustment Facility of the monetary policy. 1998 recommended by the Narasimham Committee 2, and then 1999 interim LAF, and then followed by full-fledged LAF in 2000. I mean from the 5th June 2000. This is the chronological order you should note for the exam point of view. Okay, and then see, now we are through. Like, what are the major components of the Liquidity Adjustment Facility? We already discussed about it. Okay, major components. So you can see that MSF is there, call money rate is there, repo rate is there, and then the SDF is there. And then, what's the meaning of marginal standing facility? That's the upper ceiling of the monetary policy corridor. What's it? That's the upper ceiling of the monetary policy corridor. And then the middle, that's the repo rate. These are the two items. First, we are going to discuss about the monetary policy corridor. Technically and by definition, repo rate as well as MSF are one and the same. The rate at which the Reserve Bank of India lends loan to the commercial bank, that's the repo as well as MSF. But one change is there. One difference is there. What's it? In both cases, you have to submit government security in order to get loan from the Reserve Bank of India under repo as well as the MSF. But the change is, The government security that should be above the SLR requirements if you are borrowing under repo rate, and then that is within the SLR requirements in the case of the MSF. The MSF was suggested by Deepak Mohanty group, and this was introduced in 2011-2012 monetary policy. Okay, and then MSF was one of the additional borrowing facility available for every commercial banks if they are having short-term mismatch for loan purposes. Okay, in order to meet more systematically, more transparently short-term mismatches, the Reserve Bank of India then 2011-2012 introduced the MSF. So, what's the conclusion? Repo and MSF, the same. The rate at which the Reserve Bank of India lend money to the commercial bank. The difference. In both cases, you have to pledge the government security as collateral. But in the case of repo, that's above the SLR requirements. But in the case of MSF, that's within the SLR requirements. That's the change. And you know that the third item, the floor rate. Then it was reverse repo, and now it is the standing facility. So, if you check the monetary policy history, first ever time, the ceiling rate, that's MSF, and then the floor rate, that's the SDF. Both are standing facility. Both end, upper ceiling and then the floor rate. Now we are having standing facilities. Upper ceiling is the marginal standing facility, and then the floor rate is the SDF, standing deposit facility. And see, recently Reserve Bank of India increased the repo rate. You might have read. Okay, so through a press release, the Reserve Bank of India governor informed us that unanimously Monetary Policy Committee decided to increase a repo rate by 40 basis points. Okay, and then what's the monetary policy corridor and what's its width? We know that actually. The width of the monetary policy is right now 50 basis points. And repo rate is independent and changing autonomously. So, the width of the corridor is 50 basis points. And then what will be the MSF and what it would be the SDF? That's the question. Okay, so a repo, the middle, that's the X. X plus A, that's the upper ceiling MSF. X minus B, that's the floor rate SDF. And the width is 50 basis points, half percentage, 50 basis points. And the system is automatic. Like, what's it? Right now, the repo rate was increased from 4% to the 4.40. Then, 25 basis points above X plus A, that's the MSF. That's automatic. So, 4.40 plus 0.25 is equal to 4.65. Automatically, MSF is being declared there actually. If the repo is 4.40%, 25 basis points above, that would be MSF, and 25 basis points below, X minus B, that would be the SDF. So, 4.15, that's the SDF. And when you talk about the monetary policy corridor and then the LAF, you have to understand that there are two processes. You know, what is LAF? The money supply of the economy is being controlled, okay, through the monetary policy instruments. Predominantly, repo, MSF and SDF. These are the instruments, major instruments we are using there with the support of CRR, SLR and some other monetary policy instruments. But you know that if you want to control the money supply, first you have to control the injection and then you have to control the absorption. So, what's the purpose of repo? Repo, the purpose or the function is exactly nothing other than injection of the money supply. On the other hand, reverse repo, then and now the SDF, the purpose is exactly absorption. So, the injection is done through the repo and the absorption is done through the SDF as well as the reverse repo. Then, and the monetary policy corridor is now exactly the width is 50 basis points. So, what do you mean by the monetary policy corridor? Width is equal to 50 basis points. Automatically, if you are declaring the repo rate 25 basis points above, that would be the MSF, 25 basis points below, that would be the SDF. For example, recently, before it was the repo, then recently they increased the repo rate from 4 to 4.40, then 25 basis points above MS of 4.65, and then 25 basis points below, that's the SDF, 4.15. So this is the recent policy rate, and you note the point. If you are an aspirant, you need not to by heart MSF and SDF rate, because if you know what's the repo rate and what's the monetary policy corridor, and then it's automatic, and the corridor is 50 basis points. Another example, let us say for an example, just suppose that 6 is the repo rate, 6 is the repo rate, and 50 is the basis points of monetary policy corridor. Then MS of that would be automatically 25 basis points above 6 plus 25, 6.25, 6.25%. That would be the MSF. And then 5.75, that would be the SDF or reverse repo. So that's it. Independently varying policy rate, short-term policy indicator. That's actually what? The repo. Once the repo is established and the monetary policy width is also available, then you can automatically say what would be MSF and what would be the SDF. Students, note the point. You need not to study separately what's MSF and what's SDF if you know a repo which is independent and if you know about the monetary policy width. For here, it is 4.40 and width is 50%. 25 basis points above, that's the MSF. 25 basis points below, that's the SDF. So simple. Okay. And then this is one of the questions appeared for the NTA UGC NET exam for economics students. Okay. Which one of the following is the correct sequence in the ascending order in its magnitude? That's the question. Ascending order in its magnitude. And given items are repo, reverse repo, SLR, and then the MSF. Okay. Let us see. Just right now, okay, you know what's the meaning of monetary policy corridor and what's its arrangement? It's like that, the middle, that's the repo, the upper ceiling rate, what's it? The MSF, and the floor rate, then it was reverse repo and now it is SDF. Then check the options given here. You have to find the ascending order, right? Ascending order. If you are through the ascending order, you have to start from the least. Am I right? You have to start from the least. So the option A is starting from the repo rate. No, repo is not the floor rate. If it is ascending order, you have to start from the least. Here the least as per the monetary policy corridor is what? SDF, the floor rate. So here option A is starting with the repo rate. Then it was reverse repo, the floor rate, okay, in 2019. But option A never will be the answer because we are starting the order. Order is ascending and you have to start from the floor rate, and option A is starting from the repo rate. Repo rate is the middle item there actually. So the option A never will be the option. Okay. And then what about the option B? Option B is like that SLR, yes, that's highest, and then MCLR, yes, MCLR, you know that the upper ceiling, and then the followed by repo, okay, that's the middle, and then the reverse repo, that's the floor rate. But this is not the ascending order, this is the descending order. You know that here it is MSF, upper ceiling, and then middle, that's the repo, and followed by reverse repo. This is what? This is exactly the descending order, okay. And then what about the option C? Option C also starting with the middle item, that's the repo. Never that would be also the answer because the order is ascending. So you have to start from the least item, that's the floor item, that should be then the reverse repo. Then we are starting again in this option with the repo rate. So C will not be the answer. And what about the D? Yes, you know that the floor rate then in 2019, it was reverse repo. Now it is, you know, in 2022, it's SDF, but then it was reverse repo. Yes, floor rate, reverse repo, ascending order. You are starting from the least item, that's the floor rate. And then followed by repo. Yes, middle, that's the repo. Okay. And then what it is? upper ceiling, that's the MSF. And finally, you know that SLR is almost 18%, so the highest item ever actually. But suppose that you don't know exactly what is the percentage about the SLR. Doesn't matter actually. If you know the monetary policy, LAF corridor and the width and then its order, you can exactly answer this question. So what's the answer here? Ascending order. What's the order of the Liquidity Adjustment Facility corridor? Floor rate, SDF, middle, repo, upper ceiling, that's the MSF. Look here, the option D, starting from reverse repo, the floor rate, exactly followed by middle. Repo, yes, absolutely, and then the upper ceiling, MSF, and then the highest item, SLR, that's the correct order. This kind of questions, they have been asking for many times for UGC NET students, those who are preparing for UGC NET economics as well as commerce students actually. Okay, and then, so this is the corridor. If you know the corridor, you know what's the floor rate, what's the repo, that's the middle, that's the upper ceiling, that's the MSF. So the answer is D, that would be the right answer. So not the point. You need not by heart to make the ascending order, descending order. Just know about the monetary policy, corridor and its width and its arrangements. What's the floor rate, what's the middle, what's the upper ceiling. Then so easy for finding ascending order and descending order. You are never want to by heart the things actually. This is the technical method if you know the Indian economy. Okay, so that's it. Students, please note the point. Okay, those who are preparing for the UPSC as well as the NTA UGC NET exams, these are the most important point you have to keep in your mind when you are preparing. Please don't by heart things, especially rates. Just understand the system there actually and then just follow it. So simple. And then now to the another question, second question. This question appeared for the commerce batch for the NTA UGC NET exam 2022 shift to September. See, the reverse repo is a tool used by the Reserve Bank of India primarily for the purpose of what? Already we know that. LAF, we are controlling the money supply through the injection as well as the absorption. Already I told you that. Repo, the purpose is injection. Reverse repo, the purpose is absorption. Okay, and now SDF, the same, the absorption purpose is there. So, what's the answer? What's the answer? The central point of LAF, you all know that. I already told you. I already had a detailed discussion about this same. Okay, which means the upper ceiling what it is, the middle what it is, and then the lower ceiling. And then the money supply, how it is being controlling through the injection as well as the absorption. Injection is done through the operation of repo and absorption is done through the operation of SDF now, and then it was reverse repo, and then the right now the monetary policy corridor width is 50 basis points. 50 basis points. Now you just check the question. What's the purpose of the reverse repo? Absorption of the liquidity. Okay, so that's all. This may help you in your preparation. Okay, and note the point, every aspirants, especially if you are preparing for UPSC or the NTA UGC NET, Indian economy is one of the major area you have to keep updating things. And thank you. See you again with the similar kinds of topic. Bye bye.